So let me introduce this topic called financial instrument. Now, as a company, there are various ways in which you can borrow finances as a company. Let's refer to you as company A. You can decide to borrow finances as a company by either issuing shares, or you can issue debentures, or you can issue bonds. These are various ways in which you as a company, you can borrow finances. It is obvious somebody somewhere will have to provide you with the finances you are looking for. That person, or it could be a company, let's refer to that as B. Maybe it's a company B or a person B. He will either buy, that B will either buy your shares, he will either buy your bonds so that you get the finances you're looking for, or he will buy your debentures. Now, in the language of financial instrument, we refer to B as the investor, or we refer to him as the lender. He is the one lending you as company A the finances you require. You, company A, we normally refer to you as the borrower. We normally refer to you as the borrower. You are the one borrowing these finances, either by issuing shares, or by issuing debentures, or by issuing bonds. An investor somewhere will have to buy your instruments. Either he will buy your shares, or buy your debentures, or buy your bonds. That investor, we also refer to them as a lender. Now, when you look at it from the point of view of the investor, these instruments will create to them what we call a financial asset. It's an investment. They will have an investment which we shall be referring to them as a financial asset. So to you B, when you are investing in buying shares of A, in your books you B, you will have an account called investment in shares of A. If you buy the debentures of A, you B, then in your books you B, you will have an account called investment in debentures of A. If you B, you buy bonds of A, in your books you will have an account called investment in bonds of A Limited. So to you as an investor, these instruments will create to you an investment which we normally refer to as a financial asset. Okay? While to the borrower, if the borrower is raising finances by issuing shares, then it will create in their books, what we call equity capital. It will create what we call equity capital. When a company is issuing shares, then in their books it creates what we call equity capital. It creates what we call equity capital. But if A is raising finances by issuing debentures and bonds, then in the books of A, it will create what we call a financial liability. It will create what we call a financial liability. Why? Because you as a company A, you have an obligation to pay back these debentures or these bonds. When the bonds will be redeemed, or when they will be maturing, you will be required to pay back that amount. So in your books UA, it will create what we call a financial liability. Now, so we want to define first what is a financial instrument. What is a financial instrument? But I hope you have seen how it operates. We normally define a financial instrument as a contract. It is normally a contract that leads to a financial asset to one party, which is that party is the investor, which we are referring to B. A financial instrument is a contract that leads to a financial asset to one party and a financial liability or equity capital to another party. To another party. And then we normally say to the investor or the borrowers, a financial instrument will create. To the investors, it will create what we call a financial asset. It will create what we call a financial asset. While to the borrower, a financial instrument will create what we call equity capital or a financial liability. So that is in simple how we normally define a financial instrument. We are saying a financial instrument is what? It's a contract that leads to a financial asset to one party and a financial liability or equity capital to another party. I've also said to the investors, a financial instrument will create what? A financial asset. While to the borrower, a financial instrument will create what? It will create either equity capital if they're issuing shares, or it will create financial liability if they're issuing bonds or debentures. Good. Now we can proceed. Now, whether to the investors, listen to this now, whether to the investor or to the borrower, how will they recognize this financial instrument in their books? Whether to the investor or to the borrower, when they are signing that agreement, that means on that initial recognition, how are they required to recognize that financial instrument? What we want to discuss now is what we call recognition, and measurement. Recognition and measurement of financial instrument. Recognition and measurement of financial instrument. I have already told you that to the investor or to the lender, these instruments will create an investment, a financial asset. Let's, for purpose of assumption, assume that company A was raising finances by issuing shares. Then you B, you bought maybe 10,000 shares. Let us assume you bought 10,000 shares of company A. So in your books, you will have an account called investment in shares of A Limited. Investment in shares of A Limited. Of course, you will debit shares and credit cash. Let us assume that you bought these shares at how much? At maybe 50 shillings each. So you will recognize your investment at 500,000. You bought 10,000 shares of A at a price of 50 shillings. So you had to spend 500,000 to buy the shares. So you B, you will have an account called investment in shares of A. You will debit that account and you'll credit cash by how much? By 500,000. Now listen. So all the stakeholders, that means the parties, when they are signing that contract, they are required to recognize all financial instruments should be recognized initially at the initial recognition. That means at the initial recognition, all financial instruments should be recognized. All of the financial instruments should be recognized at their fair values. At their fair values. Like for example, I have said B bought 10,000 shares at a time when the market value, when the fair value is the same as market value, when the fair value of the shares was 50 shillings. So the market value or the fair value of the 10,000 shares is 500,000. So either party, we are saying whether the investor or the borrower, we are saying the requirement is they should recognize this financial instrument at its fair value. Now, like I've already shown, B recognized the investment at 500,000, which is the market value. Now the question is, at the end of this year, at how much will they carry down the balance here? At what balance will they carry down that investment? How do they measure the investment in the subsequent period? In the subsequent period, how do they measure their financial instruments? Now, how they will remeasure these parties, both the investor and the borrower, how they remeasure the financial instrument in the subsequent period now depends on the classification. Listen, it depends on the classification of the financial instrument. In other words, is it a financial asset that we are dealing with, or are we dealing with a financial liability? How they remeasure their instruments depends on the classification of the financial instrument. Is it a financial asset or is it a financial liability? If it is a financial asset, there are three ways in which that financial asset can be remeasured. If it's a financial asset, like for example, we have seen if from the point of view of B, listen, from the point of view of B, whether they bought the shares, whether they bought bonds, whether they bought your debentures, then it's an investment. It's a financial asset. So B will measure that investment initially at its fair value, okay? But in the subsequent period, we are saying how he will remeasure that investment depends on whether it's a financial asset or a financial liability. And if it's a financial asset, I have said now, there are three ways in which that investment can be remeasured. One, it can be remeasured at what we call at amortized cost. It can be remeasured at amortized cost. We shall discuss later what is amortized cost. That's one way. The second way is that it can be remeasured at fair value. It can be remeasured at fair value through what we call OCI, through OCI. In other words, through other comprehensive incomes. You measure it at fair value through OCI. That is other comprehensive incomes. The third way is to measure that financial asset at fair value. That's another way. You can measure it again at fair value through P&L, Let me explain the last two first. When we say you measure the financial instrument at the end of the year at fair value through P&L, what do we mean? It means go back, find out. Yes, you are 10,000 shares. By the end of the year, what was their market value? What was their market value, or what was their fair value? Let me assume that one share by the end of the year has a market value now of 60 shillings. Your 10,000 shares now will have a market value or a fair value of 600,000. That is what you will now carry down by the end of the year. In your investment account, you will carry down a balance of 600,000. Remember, by the beginning of the year, it was worth 500,000. By end of the year, it is now worth 600,000. There is a gain of 100,000. That gain, now listen, that gain of 100,000 will be taken either, will be taken either through other comprehensive income or through P&L. If it is a financial asset which you are required to take it through P&L, then the difference here of 100,000, you will debit the investment account and you'll credit P&L account with that gain. Okay? If it is one where you are required to measure it at fair value through P&L, at fair value through P&L. Otherwise, if it's the one that you are required to measure at fair value through OCI, then it means you take the 100,000 not to the P&L account now, but you take it to other comprehensive incomes. Of course, you have done published accounts. You have done published accounts in financial reporting. You know that whenever a company is preparing the statement of income or income statement or what we call comprehensive income, once they have shown the incomes, they are required to show other comprehensive incomes. We have already discussed that. You in your financial reporting, you know that there is a section of the income statement we normally refer to as other comprehensive income. So if the investment is one where it is to be measured at fair value through OCI, then that gain of 100, now you don't take it to the profit and loss Yes, it's a gain, but the rule will not require you to take it through profit and loss, but you take it through other comprehensive incomes, meaning you show it as part of other comprehensive incomes. Good. We shall look at which ones are they that investment, which kind of investments are they that gain I should take it to the P&L account, or that gain I should take it through other comprehensive income. We shall look at those rules later. We shall look at those rules later. Which one of them should be measured at fair value, which one of them should be measured at fair value through P&L account, and so on. That's what we shall look at later. Okay, but just for now, I just wanted to show that the through P&L, you take the gain or loss. It could be a loss. Maybe the investment now will have a market value of 400,000 by the end of the year. By the beginning of the year, it was 500. Now it's worth 400 at the end of the year. Then the difference of 100 will be a loss. Take it either through P&L or you take it through other comprehensive incomes. Good. Now, having said that, now we want to look at, we want to look at now which kind of investments should be measured at one, amortized cost. Which kind of financial assets are these that should be measured at two, fair value through through OCI? Number three, which kind of financial assets are these that should be measured at fair value through P&L? Those are the characteristics. We want to look at the characteristics of this investment. What makes a financial asset to be measured at amortized cost? We have not discussed how to calculate the amortized cost, no, but we shall discuss in a short while. But just know that a financial asset at the end of the year can be measured either at amortized cost or at fair value through OCI or at fair value through P&L But we want to talk about what are the characteristics of a financial asset, or in other words, what are the characteristics of an investment that should be measured at amortized cost? What is the characteristics of that financial asset which should be measured at fair value through OCI, and which kind of financial asset should be measured at fair value through P&L? Good. Then from there we shall also discuss how do you measure financial liabilities. But maybe before we go on, let's put down something on what we have already said. So put down the topic. The topic is financial instrument. Let's put down the few points that we have already mentioned. So the topic is financial instruments. Financial instruments. Then you say this. Financial instrument. Then you say this. Financial instrument is a contract. Financial instrument is a contract. Financial instrument is a contract that leads to, financial instrument is a contract that leads to a financial asset to one party. Financial instrument is a contract that leads to a financial asset to one party, and a financial liability, or equity capital, and financial liability or equity capital to another party, another paragraph. Say this. To the investors or lenders, a financial instrument would create. To the investors or lenders, a financial instrument would create a financial asset. Full stop. Then you say this. To the borrowers, financial instrument creates. either equity capital or financial liability. Creates either equity capital or financial liability. We have said to the borrower, financial instrument would create either equity capital or financial liability Good. That's all for the introduction part of that. Then you have another subheading. Put down another subheading. Recognition and measurement. Recognition and measurement of financial instruments. 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 Then you say this. Say this. All financial instruments should initially be measured. All financial instruments should initially be measured at their fair values. All financial instruments should initially be measured at their fair values. At their fair values. Will you stop? Subsequent measurement depends. Subsequent measurement depends on the classification. Subsequent measurement depends on the classification of the financial instrument. Subsequent measurement depends on the classification of the financial instrument. Subsequent measurement depends on the classification of the financial instrument. i.e. whether it is a financial asset or a financial liability. i.e. whether it is a financial asset or a financial liability. Good. Another paragraph. Financial assets can be remeasured. Financial assets can be remeasured in any one of the following ways. Financial assets can be remeasured in any one of the following ways. Financial assets can be remeasured in any one of the following ways. Number one, at amortized cost. Number two, at fair value through OCI, put it at fair value through other comprehensive income, put it in full. Number two, at fair value through other comprehensive income. At fair value through other comprehensive income, in bracket OCI. In bracket OCI. In bracket OCI. Number three, at fair value through P&L. At fair value through P&L. At fair value through P&L. Okay. Now, so let me go through now. Allow me to now go on. Allow me now to go on with the discussion. Listen now. We want to discuss now what are the characteristics of assets that should be measured at amortized cost, at fair value through OCI, or at fair value through P&L. So allow me to discuss them first before we put them down. Allow me to discuss them first before we put them down. So we are discussing about financial assets. We have said financial asset, don't write. Financial assets can be measured in any one of the following three ways. We have said financial asset can be measured either, one, here at amortized cost. Amortized cost. That's one. Two, we have said it can be measured at fair value through OCI. Fair value through OCI. Three, we have said it can also be remeasured at fair value through P&L. Good. So let me now discuss which kind of assets should be remeasured at fair value, at amortized cost. Now listen, I want to take you back to where we started. I told you that you as a company A, there are various ways in which you can raise finances. We said you can raise finances by either issuing shares, or you issue bonds, or you issue debentures. Let me assume that you as company A, you issued a 10% bond whose nominal value maybe was 200 million. You as an investor, listen, you as an investor, you went and bought that bond. Or let us assume company A issued a 10% debenture, whose nominal value was 100 million. You as an investor, you went and bought that debenture. So to you is a financial asset. Listen, if you buy the bonds or you buy the debentures, listen, to you as an investor, they guarantee you two things. One, you are guaranteed of income as interest income every year. If you buy the bonds worth 200 million, then every year you'll be getting a 10% interest. 10% interest. So 10% of 200 million, every year you are guaranteed an interest income of 20 million, 10% of 200 is 20 million. So you'll be getting 20 million every year, 20 million every year until the bond matures. Then, in the year of maturity, whichever the year, maybe after 5 years or 10 years, you're also guaranteed of another receipt. That means the amount on redemption, which could be the 200 million if the company is redeeming the bond at par. Okay? So you are assured, listen, you are assured of the principal amount. Good. Now, so when you buy any of these two, whether debentures or bonds, they guarantee you those two. Now, if an investment is to be measured at amortized cost, then it must have these two characteristics. Number one, it must be an investment which you as an investor, you remember you are dealing with a financial asset. The borrower does not have financial asset. It is an investor who has a financial asset. So we are looking at this from the point of view of the investor, not the lender. The investor or the lender, not the borrower. The borrower, we say to them, it creates either equity capital or financial liability. But so when we are discussing here financial asset, we are looking at them from the point of view of the investor. We are looking at it from the point of view of the investor. So let me go on now. Okay. Now, I'm saying for a financial asset to be measured at amortized cost, it must have two characteristics. Number one, it must be one where you as an investor, you have decided to buy, which means it is held. One, which is held. Two, maturity. You are holding it to maturity to collect. To collect. You are holding it, or your aim is to hold it to maturity to collect what we call contractual. To collect contractual cash flows to collect contractual cash flows. Your aim as an investor is to hold that investment to maturity and to collect contractual cash flows. What are these contractual cash flows? It is the interest every year that you will be receiving, interest every year that you will be receiving, and the principal in the year of maturity. Okay, so that's one of the characteristics, that it must be one where it is held to maturity in order to collect contractual cash flows. Number two, the cash flows, we normally say cash flows are for payment. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. The interest that you'll be receiving every year, that is a contractual cash flow. And two, the principal that you'll be receiving at the end of maturity. At the end of maturity. So those are the two characteristics for a financial asset to be measured at its amortized cost. We have said, one, it must be one that is held to maturity. That means you are buying it to keep the investment until maturity. In order to do what? To collect the contractual cash flows. Number two, we are saying those cash flows are for payment of interest and principal. Good. That's all. So like when you buy the 10% bond or you buy the 10% debenture, they fall under this class. You have to remeasure them at what we are calling the amortized cost. Listen. So far again, we have not discussed how to calculate the amortized cost, but just know that when the investment meets those two characteristics, it should be remeasured at amortized cost. We shall discuss later how do you calculate the amortized cost. How do you calculate the amortized cost? Good. Now we come to the next one, and that is financial assets that should be remeasured at fair value through OCI. At fair value through OCI. Under this category, we have two subcategories. Under this category, we have two subcategories. We have one category we call for debt instruments. For debt instruments. And the second category is for what we call for equity instruments. Let me explain the difference. You as an investor, if you buy the debentures of company A, you are B. If you buy the debentures of company A, then we say you are buying a debt instrument. Same as you buying new debentures. When you buy the debentures, you are buying a debt instrument. Why? Because A has an obligation to pay you back your money. Okay? But if you buy the shares of A, then we say that is an equity instrument. So both of them are a financial asset to you. But now, if you are going to remeasure them at fair value through OCI, you will have to ask yourself, is it a debt instrument that I'm dealing with, or is it an equity instrument? Okay? If it's a debt instrument, like which one? Like the bond, like the debenture, those are debt instruments. Then, for it to be measured, listen again, for it to be measured at fair value by the end of the year, it's a bond, but now you don't measure it at amortized cost. You will be required to measure it at market value or fair value. What characteristics should that bond or that debenture have for it now to not be measured at amortized cost? For it to be said, we shall remeasure it at the end of the year at its fair value or its market value. Number one, what are the characteristics for such instrument? Number one, it must be an investment which is held to collect contractual held to collect contractual cash flows, listen to this now, and I'm adding something there, and to sell before maturity. Let me explain. Company A was raising finances, so they issued bonds through the stock market. You as an investor, you went and bought that bond. Okay? But you are buying it. Yes, you will be receiving the interest every year. Every year you will be receiving interest. But your aim, is not to keep that bond until it matures. No. What you are trying to do as an investor is to time. Remember, you bought it through the stock market. Company A issued the bond. You are the investor B who decides to buy that bond. But you are timing, whenever the market value of the bond will go up in the stock market, then you sell and make some profit. Okay? You are buying that bond for speculation, not for keeping until it matures. So yes, you will receive the contractual cash flows. Which are these contractual cash flows? Interest every year. Before you sell, you will be receiving interest. Listen, and if maybe by the time the bond matures, you still have not got your favored price in the market, then you will still receive your principal. But otherwise, your aim is not to receive the principal, your aim is to sell it before maturity. But you will be receiving your normal cash flows, interest every year. But in case you don't sell before maturity and maturity date come, you will receive the principal. So number 2 characteristic under that is that, again, cash flows are for payment. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Good. So I hope you have noted the difference between those investments that should be measured at amortized cost and those which should be measured at fair value through OCI if they are debt instruments. The difference is that one, you are holding it until maturity. Those are the ones we say they are measured at amortized cost. The other one, your aim is to hold them to collect contractual cash flows, but you are aiming to sell before maturity. That's what we are saying here. Sell before maturity. Sell before maturity. But you will receive your contractual cash flows. Good. So if you have such investments which are in form of debt, like bonds or debentures, then by the end of the year, utajiuliza, you will ask yourself, what is the market value of the bond? If you have not sold an investment by the end of the year, you want to measure it by the end of the year, what's the market value of my bond? Whatever is the market value, that's what you will carry down the market value. Then the change in fair value, you take it through other comprehensive incomes. Good. Next, still under fair value through OCI, what if you are buying a debt instrument? No, an equity instrument. Which kind of an investment is this? That as an investor, if I buy it, I'm going to be required to measure it at fair value, and the change in fair value, I take it through OCI. Which kind of financial asset is it? If it's an equity instrument, meaning you, investor B, if you buy shares of A, then listen, if you are buying them with an aim, listen, if you are buying those shares of company A with an aim of keeping them for long term, you are not buying them for speculation. You are buying the shares of company A to keep them for long term, then those are the shares that can be measured at fair value through OCI. So we normally say under this category, this is for shares that are not for trading. Shares not for trading. That means, i.e., for long term. You want to keep them for long term. Your aim of buying the shares of this company is to keep the shares for long term, not for trading. So if you buy the shares for the company A and you want to keep them for long term, come the end of the year, what is the market value of the shares? What is the fair value? Whatever is the fair value, the change in fair value is the one now you take it through other comprehensive incomes. Good. So I'm through with the second category of financial assets, those which should be remeasured at fair value through OCI. We have said under that we have two subcategories. Either you are buying a debt instrument, or you are buying an equity instrument. Good. Now we go to the last class of financial asset. What kind of financial asset are these that should be remeasured at fair value through P&L? Now listen. If as an investor you have a financial asset that cannot be measured at its amortized cost, if you have a financial asset which cannot be measured at amortized cost, neither can it be measured at fair value through OCI, then the only other way you can remeasure it is at fair value through P&L. So we normally say the ones that should be remeasured at fair value through P&L are any other financial asset. This is for any other financial asset. Let me give an illustration or an example. Suppose you bought shares of company A, but you are buying them with an aim of selling them before they mature. No, sorry, you are aiming to sell them anytime you make a gain. That means for trading. You are buying shares of company A for speculation, not for keeping them for long term. So if you bought shares of company A and you are buying them with an aim of speculation to trade anytime, then you can't measure them at amortized cost. You can't measure them at fair value through OCI. The only other way you can remeasure them is at fair value through P&L. So we can even say here, e.g. shares for trading. E.g. shares for trading. Those are the example. That's an example of a financial asset that can be measured at fair value through OCI, through P&L. Good. So I think I'm through. Listen, I think I'm through now with how financial assets should be remeasured. We started by saying financial asset can be remeasured in three ways: either at amortized cost, or at fair value through P&L, or through OCI, or at fair value through P&L. Okay. Then I've taken you through what kind of financial assets are these that should be remeasured at amortized cost, for example. And we have said for a financial asset to be remeasured at amortized cost, it must have two characteristics. One, it must be a financial asset which is being held to maturity in order to collect the contractual cash flows. I said an example could be when you buy the debentures of company A or you buy the bonds of company A, they are promising you a contractual cash flow. That cash flow in terms of interest and the amount of the principal when the bond matures. Okay, so your aim is to hold that investment until it matures, and your aim is to collect the contractual cash flows. Number two, tumesema those cash flows are for payment of interest and principal. Good. So that's all. So when a financial asset is of that nature, measure it at its amortized cost. I told you we have so far not discussed how to determine the amortized cost. We have not discussed how to determine the amortized cost. Good. What about financial asset that should be measured at fair value through OCI? I've said that depends on whether you are buying a financial asset which is a debt instrument, or you are buying a financial asset which is an equity instrument. If it's a debt instrument, what are the characteristics? Again, two of them. The characteristics of those investments that should be measured at fair value through OCI. If it's a debt instrument, then it must be one that is held to collect contractual cash flows and to sell before maturity. And to sell before maturity. Then number two, tumesema those cash flows are for payment of interest and principal. Good. Then finally, which kind of financial asset should be measured? If it's an equity instrument, we said if it's an equity instrument, then that kind of instrument should be one that you are buying shares not for trading, but for long term. Then finally, we have said which kind of financial asset should be measured at fair value through OCI or through P&L. It is for any other financial asset, e.g. shares for trading. Good. Now, let me take you back now. We say here, I'm taking you back. We say that financial asset, financial instrument initially should be measured at fair value. I told you in the subsequent period, it depends on the classification of the financial instrument, whether it's a financial asset or is it a financial liability. We have discussed about financial assets. Now I want to discuss what about financial liability. How do you remeasure them? Initially, again, don't forget, you measured them at fair value. But in the subsequent period, listen, financial liability cannot be in the books of the investor. Financial liability cannot be in the books of the investor. In the books of the investor, they have a financial asset. In the books of the lender, no financial liability. That is a financial asset because he's an investor, he's the lender. But in the books of the borrower, is the one who will have a financial liability. Maybe he issued a 10% bond or he issued a 10% debenture. That means they have an obligation to pay back. Okay? So how will company A measure such a financial liability? Now, at the end of the year, company A will be required to measure that bond or that debenture at what we call its amortized cost. You measure the financial liability at amortized cost. Unless, listen, unless company A issued them for speculation. Speculation. That means for trading. If for trading, listen, I will explain. If for trading, a company A, listen, a company A is raising finances. They issued the bonds through the stock market. Now listen, it may be that company A does not want to keep that bond until it matures. Listen, what they are planning to do is this. Because they issued the bond through the stock market, they want to time when the market price of the bond goes down, they redeem the bond. That means they buy back the bond. For example, if the company A was issuing a 10% bond whose nominal value is 200 million, maybe one bond has a market value of that time at a market value of 1,000. One bond or one debenture. But then at the end of the year, the company A realizes in the stock market, the bond is now worth 800. Remember, as an investor, you give the company 1,000 for each bond. But now that the market price is 800, the company can pay you back your 800. Remember, you gave them 1,000, but they pay you back 800 to redeem the bond. So they have made a gain. So, of course, not so many companies issue bonds for that kind of speculation. No. Whenever company issue bonds, they normally issue them to receive or to raise finances for long term. in case it is for trading or speculation, then as a company, you are required to measure them at fair value through P&L. You measure them at fair value. It's a liability, yes, but you issued it with an aim of speculation. So by the end of the year, utajiuliza, what is the market value of this bond? What is the fair value of this bond at the end of the year? Then you measure that bond at its fair value, and the change in fair value, take it through P&L. But it's rare you find a company issuing bonds for speculation. Normally they issue them to raise term finances for long term. Therefore, you will obviously be required to measure them at their amortized cost. Good. So before we go on and discuss how to compute the amortized cost now, let us put down something on what we have already said. Let's put down something on what we have already said. I said financial assets can be measured. I think we said recognition and measurement. Then I talked about, listen in our notes, we said financial instruments should initially be measured at their fair value. Then I said in the subsequent period, their measurement depends on the classification, whether it's a financial asset or a financial liability. Umesema for financial asset, it can be either at amortized cost fair value or through a fair value through P&L. Now we are adding by saying if it's a financial liability, it should be measured at its amortized cost. Now, maybe for financial asset, let's copy this chart. I don't have to rub it. I think it explains everything. Copy that chart and have that chart, financial asset. Then you have those three branches. That is at amortized cost. Number 2, at fair value through OCI. And number 3, at fair value through P&L. Have those three branches. The first branch is at amortized cost. Number 2, at fair value through OCI. Number 3, at fair value through P&L. Then below that, you can now start with the first category at amortized cost. We have said what are the characteristics. There are 2. I'll copy those 2 characteristics. There are 2. Number 1, we have said for amortized cost, we have said held to maturity to collect contractual cash flows. Held to maturity to collect contractual cash flows. That was number 1. Then below that, tumesema number 2. Number 2, we have said cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Good. I think we are through with the first category. If you are through with the copying of that section, we can now go to the second part. Number 1, we have said held to maturity to collect contractual cash flows. Number 2, cash flows are for payment of interest and principal. Then you can now come to the second category where we said at fair value through OCI. That was the second branch. Then you can subdivide it further. Number 1, where we said for debt instruments, that was for debt instruments. This was for debt instruments. This was for debt instruments. Then the second branch, sub-branch, was for equity instruments. For equity instruments. Then for debt instrument, have the two characteristics. Number one, for debt instrument, you have those two characteristics. Number one, held to collect contractual cash flows and to sell before maturity. Held to collect contractual cash flows and to sell before maturity. Held to collect contractual cash flows and to sell before maturity. Remember, the key word there is to sell before maturity. Held to collect contractual cash flows and to sell before maturity. Number two, cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Okay, that's number two. That is for debt instruments. So finish copying for debt instrument. We want to go to number next. That is for equity instruments. For equity instruments. Equity instruments. I hope you can see already. We can say this for equity instruments. We said, under the equity instrument, we said, for shares that are not for trading. For shares that are not for trading, i.e., for long term. I.e., for long term. Not for trading, but for long term. Or you can even call it to keep it for long term. Keep for long term. I.e., keep for long term. I.e., keep for long term. Shares that are not for trading, i.e., to keep for long term. Okay? That is all for branch number 2. That is through fair value through OCI. Let's now go to the third branch. Let's go to the third branch, or the third way, where we said at fair value through P&L. The last branch there. The last branch there. At fair value through P&L, where we said for any other, put it that way, for any other financial asset. For any other financial asset, e.g. shares for trading. E.g. shares for trading. E.g. shares for trading. E.g. shares for trading. Okay, good. To finish, I want to develop the topic now. No, we are not yet through, because we have already discussed about financial liability. So once you're through with the chart, copy the chart first, then we put down the point down there for financial liability. Copy the chart, finish copying the chart. Okay, I hope you are through with the copying of the chart. Now andika somewhere below that, below the chart. You can say this below the chart. For financial liabilities, they should be remeasured. For financial liabilities, they should be remeasured at their amortized cost. They should be remeasured at their amortized cost. they should be remeasured at their amortized cost unless, continue, unless they are for trading. Unless they are for trading. Unless they are for trading, whereby, unless they are for trading, whereby they should be remeasured, unless they are for trading, whereby they should be remeasured at fair value through P&L. They should be remeasured at fair value through P&L. At fair value through P&L. Okay. Okay, so let's continue now. I hope we are together so far. I hope we are together so far. You can chat and say yes, so that I know that we are together so far. Are we together so far? You chat and say yes. You chat and say yes, that we are together. Good. Thank you. Thank you. Let me develop the topic now. Let me develop the topic. Now listen to this again. I started by saying, listen, all financial instruments, whether to the borrower or to the lender, I said all of them should be measured how? At their fair values. So the question is, how do you determine the fair values? Then we shall look at the subsequent period, either at fair value or amortized cost. Now, a company A, let me illustrate. A company A was raising finances. They issued a 10% bond whose nominal value was 200 million. Listen, but for them to receive this money they are trying to raise, they found out that the only way to get the money faster from the investors is to issue these bonds maybe at a discount. So yes, the nominal value was 200 million. But to raise the finances, the company decided to issue these bonds at a discount. Let's say you are told by the question, they issued them at a discount of 5%. So it means company A did not receive 200 million. Yes, they issued a bond whose nominal value was 200 million. But because they wanted to raise these finances a bit faster, they had to give an incentive to the investors. So when it comes to the year of redemption, they'll pay 200. But because they want to receive the money faster, they gave an incentive where they issued the bond at a discount of 5%. 5% of 200 million is 10 million. So it means, therefore, listen, that the company A effectively received how much? 190 million from the bond. That's what they received. Listen. But also, in the process of trying to raise the finances, in the process of raising these finances, you as company A, you could have hired a lawyer to prepare the legal documents. You as company A, you could have issued or hired accountants to prepare prospectus, or you could have hired a broker to be your broker of the deal when you are raising the finances. And you had to pay the broker, or you had to incur an issue cost or pay the lawyers a cost. So we are saying, if for example the question tells you that company A had an issue cost of shillings 5 million, they had to spend a 5 million to raise these finances, then it means therefore effectively, listen to this now, it means therefore effectively you as company A, you did not receive 190, effectively you received 185. That 185 million is the net proceeds from the issue of the bond. It is the net proceeds from the issue of the bond. That amount we are calling the net proceeds is exactly what we shall also be calling the fair value. So on initial recognition, you will not measure this bond at 200, you will measure it at its fair value, which is the net proceeds. So to get the net proceeds, we took the nominal value, we had to minus the discount if there was any discount, and if there was any issue cost, you as company A, you are incurring an issue cost, then you minus. Therefore, effectively, you received 185 million. That is what you classify as the fair value. So you initially measure it at its fair value, which is the net proceeds. Good. So I hope now you know how to compute the fair value on initial recognition. Get the net proceeds from the issue of that bond. It could be debentures, whatever it is. What is the net proceeds? Some questions may not have the issue cost. Some questions may not have discount. It may have just the nominal and the issue cost. Some questions may have both the discount and the issue cost. Depends with the question. Okay, good. But the point is, get the net proceeds. Good. Now that we know the net proceeds, which is the fair value on initial recognition, now at the end of the years, how shall we be remeasuring this bond? We have said, if it's a financial liability, remember, it's a financial liability. We are looking at it from the point of view of company A. Company A is the one issuing this bond. So to them, it's a financial liability, which they are recognizing initially at its fair value, but in the subsequent period, they are going to measure it at its amortized cost. So the point is, or the question is, how then do we calculate? How then do we calculate the amortized cost? How then do we calculate the amortized cost? Now, to calculate the amortized cost of this bond, you have to prepare an amortization table or schedule. Okay? To determine the amortized cost at the end of each year, you have to prepare an amortization schedule. That schedule will have a column for the balance. No, will have a column for the year. It will have a column of the balance brought down. It will have a column of the finance cost. I'm going to discuss that in a short while. It will have a column of the cash paid. It will have a column of the balance carried down. Okay? So by the beginning of year one, what was our fair value? Initial recognition, 185 million. That's what you have as your balance brought down, 185 million. Let me put the figures in millions. Good. Now, you as an investor, as a lender, as a borrower, you as a borrower, you will incur a cost, the interest charge. That is what we want to talk about, called finance cost. So because you are the one issuing this bond, you will incur finance cost. We issued a 10% bond. Listen, we issued a 10% bond. This 10% is what we normally refer to as the coupon rate. We normally refer to that as the coupon rate. You know that in finance. That coupon rate, every year, you will be required to pay the investors 10% of 200, 10% of 200, 10% of 200, which is how much? 20 million. That 20 million is the cash interest payment. Listen, that 20 million is the cash interest payment here. Every year, you will be paying 20 million. 20 million. Cash payment. 20 million. Until the bond matures. But the question is, how do you determine the interest charge, not the interest paid? The interest paid is the 20. That is the interest paid. But what do you take to your income statement as a company issuing the bond to represent your finance cost or the interest charge for the year? Now listen, in that case, to calculate the interest charge for the year, you will compute the interest charge using a rate we call the effective interest rate. The effective interest rate. The question will tell you what is the effective interest rate of this bond. What is the required market rate of return of this bond? Suppose the question tells you that the effective interest rate of this bond is 12%. 10% I've told you is the coupon rate. And we are using the coupon rate to calculate the cash payment, or what we can call the cash interest payment. But to compute the finance cost, or what we can call the interest charge for the year, you use the effective interest rate, which I want to assume the question tells you it's what rate? 12%. So you will take 12% of the fair value, not of 200. You will take 12% of the fair value at the beginning. Our fair value was 185 million. What is 12% of that? Let's calculate. 12% of 185 million looks like 22.2. But for purpose of illustration, listen, for purpose of illustration, let me just assume a round figure, 22 million. That is the interest charge for year one. Then by the end of the year, listen, what will be the balance carried down? I began the year with a liability of 185. We are being charged 22 million as interest, but we have paid 20 million as cash payment. What's our liability at the end of year one? It will be 185 plus 22 minus 20, which simply is 22 minus 20, that's 2. 2 plus 185, that's 187. So our amortized cost by the end of year one is 187 million. Is 187 million. Then that becomes the balance by the beginning of year two, 187 million. Then you take your 12% of that 187 million. Let me assume, I'm assuming that you take 12% of 187 and you find something like 23 million. I'm assuming 23 million. Then again you get the amortized cost at the end of the year two. Of course, you will pay 20 million, which is 10% of 200. Don't forget, I said for cash payment, you are computing cash payment at 10% of the nominal 200 million. That will not change. Every year you have to pay the investors 10% of the nominal, 10% of the nominal, 10% of the nominal. Good. So in year two, what is our amortized cost by end of year two? It is 187 plus 23 minus 20. That is the same as taking 23 minus 20, that is 3. 3 plus 187, that looks like 190. Then you bring it down by the beginning of the third year, that is 190. You take 12% of that. Let me assume for purpose of illustration, it's 24. So what is our carry down? 190 plus 24 minus 20, that will be 24 minus 20, that is 4, plus 190, that's 194. Then you come to year 4, you bring down 194. Let me assume you charge interest, it comes to 25. Then 25 minus 20, that's 5. 5 plus 194, that's 199. Then I'm assuming the bond will mature after 5 years. Now we are in the final year. Okay. Now listen, in the final year, I start with 199. Let me assume interest is 12% again. That I'm assuming 26. Listen to this now. In the final year, you will pay the interest of 20. But at the same time, listen to this now. At the same time, this is the year you are redeeming the bond. You are redeeming this bond. If the question tells you you are redeeming the bond at par value, then you are redeeming it at the same nominal value of 200. So you'll pay another 200. If the question tells you that maybe you are redeeming the bond at a premium. Let's assume the question tells you you are redeeming the bond at a premium of maybe 2.5%. The nominal value was 200 million, but now you are redeeming this bond at a premium of 2.5%. 2.5% of 200 million is how much? Okay, I can see it here. If 5% of 200 million gave me 10 million, then 2.5% will give me 5 million. Good. Sawa. So let me assume for purpose of illustration that the question tells you we are redeeming the bond at a premium of 2.5%. So 200 million, 2.5% of that is 5 million. So you will pay 205 million in the year of redemption on top of the 20. Once you pay the 205, there should be no balance. Let me see. 199 plus 26 minus 20 minus that. What does it come to? It looks like it clears. Good. Because this is 225. This is 225. It clears. Good. So that's how, listen carefully. That's how you determine the amortized cost at the end of each year. So like in the first year, our amortized cost by end of year 1 is 187. By end of year 2, it's 190. The amortized cost by end of year 3 is 194. And the amortized cost by end of year 4 is 199. And in the final year, there will be nothing. Why? Because you will have already redeemed that bond. To get 205, I was saying, somebody's asking how we get 205. I was saying, suppose the question tells you you are redeeming the bond at a premium of 2.5%. So 2.5% of the nominal, which is 200 million, is how much? It is 5 million. Because 10%, you remember? No, 5% of 200 million, I remember, was 10 million. So if you take 2.5% of 200 million, that is 5 million. But you are redeeming the bond at a premium of 5 million. So you will still pay the 200 million, but you will now add the premium, which now comes to 205. That's how we are getting the 205 now. If the question told you, listen, if the question told you are redeeming the bond at par, so you will have only paid 200. If the question told you, listen, if the question told you we are redeeming the bond at a discount of, let's say, 5%. 5% of 200 million is 10 million. So if you are redeeming the bond at a discount, then you will pay 190. The nominal was 200. So if the question tells you you are redeeming at par, you pay 200 million. If the question tells you are redeeming at a premium, you pay an amount higher than 200 million. If the question tells you are redeeming at a discount, then you pay an amount less than 200 million. Are you there now? Samuel, how we are getting to 205? Samuel, are you there? How we are getting to 205? Yes, good. Now let's continue. Now that you know how we are getting the amount on redemption, if the question told you we are redeeming it at a premium. Good. Now, listen to this now. You are company A, you have prepared this schedule. The sound is not clear today. Somebody saying the sound is not clear. Is it clear to some other people? Someone says it's clear. Is it clear to somebody else? Somebody let me know. The sound is not clear today. Loud and clear. Loud and clear on my side. Yes, it is. Yes, it is. Samuel, is it still loud and clear? It's not yet. Samuel, you have said on your side it was not clear. Is it not clear, Bado? It's clear? Samuel, is the sound clear on your side now? It's clear on my side. Okay, but there was somebody who was saying it's not clear. Okay, fine. I hope it's clear now. I hope it's clear now. Good. So let me continue. Let me continue. So I was saying this. This is the schedule that you prepared. But how does it affect you, company A? How does this financial instrument affect your financial statement? Sometimes the question tells you to compute that amortized cost and prepare, listen, and prepare the profit and loss extract for this company and a balance sheet extract. An extract is a section of something. So if the question told you to prepare an income statement extract or profit and loss, how will this instrument affect the income statement? Listen, every year we have been calculating the amount we are calling the finance cost. That finance cost is the interest charge for the year. And that's what you'll be taking to your income statement every year. That's what you'll be taking to your income. So when the question tells you to prepare income statement or profit and loss extract, then it's a section of the P&L account. You will have a column for the year and you'll have a column for the finance cost. So year 1, year 2, year 3, year 4, year 5. In the first year, we charge interest of 22. In the second year, I remember we charge interest of 23. In the third year, we charge interest of 24. In the fourth year, we charge interest of 25. And I think in the fifth year, our interest charge was 26. So that's all on how this financial instrument will affect your income statement or your profit and loss. What about the balance sheet? How will it affect the balance sheet? How will it affect the balance sheet? Or what you can call statement of financial position. Now, so again, I'll have a column for year 1, year 2, year 3, year 4, year 5. Now watch. In the balance sheet or in the financial statement called statement of financial position, among your non-current liabilities, those are long-term liabilities, you will have a 10% bond. Then somewhere along your current liabilities, you will also have a 10% bond. I want you to listen carefully now. I want you to listen carefully. We go back to the table. By end of year 1, I am carrying down a liability of 187 million here. We are carrying down a liability of 187 million. Listen. This bond will be redeemed in the 5th year. That's when you will redeem the bond. That's when you will pay the principal. So though I am paying 20 million every year, 20 million every year, 20 million every year, I am not paying anything of the principal amount. The principal will be paid in the 5th year, in the year of redemption. So the 20 million I kept paying was just to service the interest. Meaning, this 187 million I'm carrying by end of year 1, it will be redeemed in the 5th year. I have a liability of 187 million to be paid in the 5th year. So I'll ask myself, by end of year 1, how many more years are remaining for me to pay that 187? Because it will be redeemed in the 5th year. So I still have the 2nd year, the 3rd year, and the second year, 3rd year, 4th year, and the 5th year. So you are still remaining with 4 more years to go. It means therefore that as at the end of year 1, that 187 million will be considered as a long-term liability. It will be considered as a long-term liability. So that 187 million will be long-term. In the first year, nothing current liability, nothing current. We go back to the table again. We go to year 2. By end of year 2, I can see we are carrying down 190. Again, this will be redeemed at the end of the 5th year. This will be redeemed at the end of the 5th year. Now, I ask myself, as at the end of year 2, how many more years are remaining for me to pay the 190? I'm still remaining with the 3rd year, 4th year, and the 5th year. Those are 3 more years. They are more than a year. So I classify that 190 again as a long-term liability. So 190 by end of year 2 will be classified as a long-term liability, nothing current. You go to year 3. You go to year 3 now. You see you are carrying down 199. 199 being the balance carried down, you will ask yourself again, how many more years are remaining for me to pay that 194? I still have the 4th year, I still have the 4th year and the 5th year. 2 more years to go. So that again, as at the end of year 3, that will be classified as a long-term liability. That is 194. Nothing current. Okay, good. Now watch year 4. Now watch year 4. Year 4, we are carrying down 199. Year 4, we are carrying down 199. So I ask myself, how many more years are remaining for me to pay that 199? Remember, the bond is being redeemed in the 5th year. So it means that by end of next year, I'll have already paid it. I am at the end of year 4. I am at the end of year 4, and it means by end of next year, which is the 5th year, I should have cleared that 199. So it means, therefore, as at the end of the 4th year, I'm still remaining with less than a year to go. So that 199 will take me less than a year to pay. So you can't classify it as a long-term liability by end of year 4. You will classify it as a current liability. So in the 4th year, there will be no long-term. By the end of the 4th year, no. But that 199 will be classified as a current liability. Good. In the 5th year, don't forget, there was a dash. We were not having any liability. So in the 5th year, there will be no long-term, no current. There will be no long-term, no current. So we just put a dash by the end of the 5th year. So this is how your financial instrument will affect your balance sheet and your income statement. In the income statement, tumesema just show the interest charge for the year, which is the same as the finance cost, which is the amount we are calling the finance cost. Whatever is the finance cost each year, that goes to the income statement. In the balance sheet, whatever you are carrying down as your amortized cost at the end of each year, that is what will go to the balance sheet as a liability. Either it will be a long-term liability or it will be a current liability. If you still have more than a year to go, then it's long-term. If you still have less than a year to go to pay it, that's a current. But don't forget, I've said, all this amount will be paid by the end of the 5th year. The principal will be paid by the end of the 5th year, so it will be either long-term or current. Though I kept paying 20 every year, I was not paying the principal. I told you that I was only servicing the interest. So I was not paying any principal. Good. So I hope you're okay now. So what we shall do next time, we shall now do other subtract finance cost minus monthly payments, then balance carry down. Other subtract. I'm not getting. Let's see the argument. Other subtract finance cost minus monthly payments. That's what you can also do. You can take, I don't know whether that's your argument. Somebody called Wahome. You take 22. You take this 22 minus 20. You get 2. Add it to 185. It's the same. Or you take 185 plus 22 minus 20. Or you take the finance cost, you minus the interest you are paying, get the 2, add to 187, you get 2, whatever. I hope that's what you're saying. Other subtract finance costs minus monthly payments. Yes, that's correct. Then minus balance brought down. Apana. Then you add, because the finance cost will always be higher. We are using a finance cost. Are you okay? Because the finance cost, which is the effective interest rate, listen, the effective interest rate is normally higher than the coupon rate. And I'm hoping, listen, I'm hoping you're not confusing with the topic of leases. These are two different schedules. Lease and financial instrument are two different ones. So I'm hoping you're not confusing with the topic of lease. Lease is a different topic. That is it. Thank you. I was confusing. Thank you. So you are hoping, yeah, that's what I'm saying. Maybe you're confusing with the topic of lease, which we shall do later. Lease is a different topic. Financial instrument is different. Okay. So I was saying, see you next time. Where now we shall do a question, putting it down, but I've just done the illustration. Okay. I've just done the illustration. Fine. So let me mention one or two things. Listen. For those who have joined us today, tell your friends that we have online classes for financial reporting of the intermediate level. Tell your friends that we have financial management. We are also offering financial online classes for financial management of the intermediate. Tell your friends we are offering advanced financial reporting of the advanced level. Tell your friends we are also offering financial accounting of the foundation level and that of the intermediate. Financial accounting of the foundation level and the one of ATD1 and ATD2. Those are the four subjects we are offering financial online classes for. Tell your friends who would want to join that we have these online classes for financial reporting of the intermediate, financial management or intermediate level, advanced financial reporting of the advanced level, and financial accounting of the foundation level and the one of ATD1 and ATD2. Tell your friends also, if they are not able to join the live class, then they can buy what we call the pre-recorded videos. So that they watch the videos at their own free time, at their own pace. Okay? Tell them, if they want to reach me, you can call me on this number, 254, that's the country code. If you're using the country code, 722-65-8875. So that is the number if you want to reach me on how we can go about the online classes. 254-722-65-8875. If you don't use the country code, then it will be 0722-65-8875. Also, for some of you who have not subscribed to my YouTube channel, please click the subscription button in my YouTube channel where you can subscribe and you will be notified whenever we post videos into the YouTube. For timetable, please call me Samuel. For timetable, please call me on this number or you text. For timetable, you have said timetable, call me or text. We can discuss the timetable. Now, again, my YouTube channel is called CPA Joseph Njuguna. CPA Joseph Njuguna. That is my channel where you can click and subscribe so that you can be notified whenever we post videos into the YouTube. Okay? Good. So I hope that's all I wanted to say for now. Otherwise, see you next time where we shall now do a question on financial instrument and then develop the topic. Any other comment? I hope the sound was clear now.